Intel just jumped almost 8% today, and if you pull up the daily chart, you'll see two big peaks sitting right next to each other. A lot of traders are already calling this a double top and getting ready to bet against it. So in the next few minutes, let's do something far more useful than guess. Let's learn exactly what a double top is, how to test for one, and then put this Intel chart through that test. Because the honest answer might surprise you. First, the why. Earlier today, President Trump announced that Apple will work with Intel to design and build chips in the United States. The details were thin, no firm numbers, no timeline, but the market reacted instantly. Intel popped more than 7%, while Apple barely moved. That gap between the two reactions is a lesson all on its own, but today, our focus is the chart pattern that everyone is suddenly pointing at. Here's the thing about a day like this. A stock surges on big news, it's trading near its highs, and all at once everyone becomes a chart analyst. This is exactly the moment when one particular pattern gets called more than any other, and, more often than not, called far too early. That pattern is the double top. So before we judge Intel, let's actually understand it properly. A double top is a bearish reversal pattern. The idea behind it is simple. A stock rises, pulls back, then rises again to roughly the same level, and fails to push higher. On the chart, it looks like the letter M. Two peaks, a valley between them, and a line drawn across the low of that valley. That line has a name, the neckline. Remember it, because it is the single most important part of the entire pattern. So why does this shape form at all? Think about the people behind the candles. Price runs up to a level where enough sellers decide it's expensive. That's the first peak. It pulls back. Then buyers try again and push price back up to roughly the same level. And the very same sellers are waiting there. When buyers fail to break through a level twice, it's a clue that demand is running out of steam. That second rejection, at the same price, is the real heart of the pattern. So here is your test. For a genuine double top, you need three things. 1. Two peaks at roughly equal height, not one far higher than the other. 2. It must come after an uptrend, because it is a reversal pattern. It has to reverse something. And 3, the big one, it is not confirmed until price breaks and closes below the neckline. Until that break happens, you do not have a double top. You have two bumps on a chart. Now here's something most beginners never learn, and it changes everything. The time frame matters enormously. This same pattern can appear on a 5-minute chart, a daily chart, a weekly chart, even a monthly one. And the bigger the time frame, the stronger and more reliable the pattern becomes. Why? Because a double top that takes years to form on a monthly chart represents a massive, slow battle between buyers and sellers, huge conviction behind it. A double top that forms in an afternoon on a 5-minute chart is just noise by comparison. So the rule is simple. A monthly or weekly double top carries far more weight than a daily one, and a daily one carries far more than an intraday blip. When you spot the pattern, always ask first, on what time frame? Because that single question tells you how seriously to take it. Volume adds confidence to the picture. In a textbook double top, the second peak often forms on lighter volume, a sign that fewer buyers are willing to chase price higher. And then volume tends to spike as price breaks below the neckline, confirming that sellers have taken control. If the neckline breaks on weak volume, be suspicious. Volume is how the market quietly tells you whether a move is real or just noise. There's also a way traders estimate how far a confirmed double top might fall. And I want you to see it purely as a concept, not a promise. You measure the height from the peaks down to the neckline. Then you project that same distance downward, from the point where the neckline breaks. That estimate is called the measured move. It will not always be right, but it shows you how technicians think in terms of structure and proportion rather than emotion. Now the mistake, and it's the reason so many people lose money on this exact pattern. Beginners see two peaks, immediately call a double top, and bet on a fall. But without the neckline break, there simply is no pattern yet. The stock can just as easily turn around and push to new highs. Spotting two peaks is not a signal. Waiting for the confirmation is the entire skill. Hold that thought, because we're about to use it. So let's put Intel through our three conditions live. Peak 1, back in early May, formed around $135. Then a pullback, down toward $100. Then a second peak. But look very closely at this one. It didn't stop at the old high. It pushed to a new high, around $137. And today, price is surging again on the partnership news. Let's check that against the rules we just learned. Condition 1. Two roughly equal peaks. This fails. The second peak is actually higher than the first, which looks a lot more like strength than a top. Condition 2. It forms after an uptrend. That one fits. Condition 3. A confirmed close below the neckline. This fails too. Price is nowhere near the neckline. In fact, it's rising hard today. And remember our time frame rule. These two peaks are only about a month apart on a daily chart. So even if this somehow did confirm later, it would be one of the weaker versions of the pattern. Nothing like a multi-year top on a monthly chart. So by the pattern's own definition, this is not a double top. Not yet. It is two peaks and a bullish catalyst. Calling it a reversal right here would be exactly the mistake we just talked about. So, what would actually change the picture? There are two clear paths from here, and we are going to predict neither. If, somewhere down the road, Intel were to roll over and break below that neckline near $100 on heavy volume, then a double top would genuinely be confirmed. But if instead it breaks above these peaks, the pattern is dead, and what we're looking at is a breakout to new highs. Watching which one happens, that is reading the chart. Guessing before it happens, that is gambling. If you want to handle setups like this one, here are the concepts worth studying. And notice, concepts, not tips. How to draw and confirm a neckline. How volume confirms or rejects a break. Why the time frame changes everything. What a false breakout looks like, so you don't get trapped by one. And the most important of all, the discipline of waiting for confirmation instead of anticipating it. That single mindset is what separates traders who last from those who don't. Now, something quick, but genuinely important. This video is for educational purposes only. It is not investment advice, not a recommendation, and not a suggestion to buy or sell Intel or any other stock. I am not your financial advisor. Markets carry real risk, including the loss of your money. Please consult a registered investment advisor before making any financial decision. So, here's the one thing to carry away from today. A pattern isn't real until it confirms, and the bigger the time frame, the more it means. Two peaks are not a double top until that neckline actually breaks. And right now, Intel hasn't broken anything. The skill was never in spotting the shape. It was in having the patience to wait for proof. If this helped you read a chart a little more clearly, that's the whole goal here. We break down a fresh market move like this every week. This is the market story, from the basics all the way to advanced, one story at a time. And if this made double tops finally click for you, what they are, how to test for one, and why patience beats prediction, please hit that subscribe button. It's completely free, and it's the single biggest way you help this channel grow. Drop a like so others can find it, and tap the bell so the next breakdown comes straight to you. See you in the next one.